Market bubbles can feel unstoppable. Prices soar, optimism runs wild, and investors rush in, thinking the good times will last forever. Everyone seems to be making money, and FOMO, fear of missing out, drives even cautious investors into risky positions. But history shows that what goes up too fast often comes crashing down even faster, wiping out massive amounts of wealth in weeks or months. Many investors fail to recognize warning signs and panic when markets collapse, losing both capital and confidence. Understanding how bubbles form, why they burst, and how to protect yourself can mean the difference between financial survival and disaster. Today, we'll explore famous market bubbles, the lessons they teach, and practical strategies to safeguard your investments. By the end of this video, you'll know how to spot danger, react wisely, and emerge stronger after a market crash. 1. What is a market bubble? A market bubble occurs when asset prices rise far beyond their intrinsic value due to speculation, hype, and excessive demand. Investors buy assets not because of fundamentals, but because they expect prices to keep going up. This irrational exuberance drives prices to unsustainable levels, creating a fragile market. Many investors confuse rapid gains with long-term growth, failing to assess underlying risks. Bubbles often build slowly over years and can appear perfectly normal until the tipping point is reached. Recognizing bubbles early requires discipline, understanding valuation metrics, and careful observation. Awareness is the first step in avoiding catastrophic losses when the bubble bursts. Acting early can protect your portfolio and reduce panic during sudden market corrections. 2. Historical examples of market bubbles. History provides clear examples of bubbles and their aftermath, offering lessons that still apply today. The Dutch Tulip Mania in the 1600s saw tulip bulb prices skyrocket before collapsing entirely, ruining many investors. The 1929 stock market bubble led to the Great Depression, wiping out millions of people's savings and investments. More recently, the dot-com bubble of 2000 and the housing bubble of 2008 demonstrate how speculative manias can devastate modern markets. Each event shows similar patterns: rapid price appreciation, investor overconfidence, excessive leverage, and a sudden crash. Studying these events teaches us to recognize warning signs before it's too late. Market psychology rarely changes, making history a valuable teacher for today's investors. Awareness of past mistakes can help you make smarter decisions in real time. 3. Why bubbles burst? Bubbles burst when reality catches up with speculation, and prices no longer reflect the true value of assets. Overvalued assets eventually fail to justify their price through earnings, revenue, or other fundamental measures. Investor sentiment shifts from optimism to fear, triggering rapid selling and cascading losses. External factors like rising interest rates, economic shocks, or regulatory changes often accelerate the collapse. Leverage magnifies losses, turning minor corrections into large market crashes. Many investors panic during this phase, locking in losses and amplifying the downward spiral. Understanding these mechanics helps investors stay calm and make rational decisions. Awareness of these triggers allows you to anticipate risks and protect your portfolio before it's too late. 4. The impact of a bubble burst. When a bubble bursts, the effects can be severe and far-reaching. Stock prices, real estate values, or other assets can lose 30%, 50%, or even more in a short period. Investors who are highly leveraged or overexposed often face financial ruin. Market confidence declines, liquidity dries up, and economic activity can slow dramatically. Some sectors may recover quickly, while others may take years to regain their previous value. Individuals who panic sell lock in losses, whereas disciplined investors who maintain a long-term perspective often recover and even profit. Understanding the potential impact helps in planning for risk and avoiding emotional decisions. Being prepared allows investors to navigate the downturn with strategy rather than fear. 5. Lessons from history. History teaches several key lessons for surviving bubbles. First, never chase irrationally high returns without understanding the underlying value of assets. Second, diversification across asset classes and sectors reduces exposure to speculative bubbles. Third, avoid excessive leverage, which magnifies both gains and losses. Fourth, maintain a long-term perspective and don't react emotionally to market swings. Fifth, always monitor valuations and be wary when optimism reaches extreme levels. Applying these lessons increases your chances of surviving bubbles and taking advantage of opportunities afterward. Discipline, patience, and education are the cornerstones of long-term investing success. Learning from history helps prevent repeating costly mistakes in the future. 6. How to protect your portfolio. Protecting your portfolio involves proactive strategies and careful planning. Diversify across stocks, bonds, real assets, and geographic regions to spread risk. Keep a portion in cash or low-risk assets to act when opportunities arise during market correction. Avoid over-concentration in high-risk sectors or hyped investments. Set clear risk limits and stick to them. Resisting panic selling or impulsive buying. Regularly rebalance your portfolio to maintain alignment with your goals and risk tolerance. Preparing in advance reduces damage when markets correct and positions you to capitalize on the recovery. Risk management and discipline are far more effective than reacting after the fact, ensuring long-term wealth preservation. 7. Identifying warning signs. Certain signals often precede a market bubble, and spotting them early can protect your wealth. Rapid price appreciation with no corresponding improvement in fundamentals is a major red flag. Excessive media hype, extreme optimism, and high leverage often indicate a bubble is forming. Valuation metrics that far exceed historical norms serve as strong warnings. Sector or asset concentration combined with speculative behavior heightens the risk even further. Monitoring these signs allows investors to take defensive measures, such as reducing exposure or increasing cash reserve. Awareness and early action prevent being caught off guard when the market turns. Being proactive rather than reactive is key to surviving financial cycles. 8. Taking advantage of opportunities. Post-bubble. While bubbles destroy wealth, they also create opportunities for strategic investors. After a crash, fundamentally strong assets are often undervalued, providing attractive entry points. Those with liquidity can buy quality investments at discounted prices and prepare for the next growth cycle. Dollar-cost averaging into undervalued markets is a powerful long-term strategy. Patience, research, and preparation allow you to rebuild wealth faster than panic sellers. History shows that markets recover over time, rewarding calm, disciplined investors. Viewing downturns as opportunities rather than disasters changes your approach to investing and enhances long-term growth. Strategic thinking allows investors to profit even from market crashes. If this video helped you understand how market bubbles form, burst, and impact investors, take action now. Review your portfolio for overexposure, diversify across assets, and prepare cash reserves for opportunities. Share this video with someone who needs to understand market cycles. Subscribe for more investing insights, and hit like to support content that empowers smarter financial decisions. Studying history is one of the most powerful tools to survive market bubbles. Protect your wealth today, stay disciplined, and position yourself to capitalize on the next opportunity. Understanding the past ensures you don't repeat its costly mistakes. Take control now and build a portfolio that can survive even the wildest market swing.